Welcome to Value Added, the real estate podcast where we speak with the brightest minds in the world of real estate who provide, create, and realize value in an ever-changing market. If you're a real estate professional delivering value to your clients, an investor creating value not seen by others, or a busy professional who passively invests in real estate to grow the value of their hard-earned dollar, then you're in the right place. And now your host, Nick Walters.
Hey gang, welcome to another episode of Value Added, the real estate podcast. I'm excited about this week's episode. This is our first double interview. We're sitting down with Edmon Rakipi and Jeanine Blake. They are the co-principals of Clearwater, Florida-based Opp Zone Capital. Opp Zone is a multi-asset qualified opportunity zone fund, and they focus on the acquisition and ground-up development of multifamily, self-storage, and hospitality assets. Jeanine comes from a self-storage and medical transportation background. Her family started PODS, Portable On-Demand Storage, back in 1998, where she served as the Senior Vice President of Global Partnerships. That company was sold to a private equity fund back in 2007 for $430 million. She then went on to found a non-emergency medical transportation company. Edmon comes from a diverse background of industries, primarily in the hospitality and restaurant industry, the grocery industry, and the financial services industry in a operations and management capacity. So without further ado, let's get on with the show. Edmon Rakipi and Jeanine Blake, welcome to the show. Good to have you both.
Thanks for having us.
Yeah, thank you.
This is a historic episode. This is my first episode with two guests at one time. So if it gets bumpy, our listeners are going to have to enjoy the ride. So it's awesome to have you both on. So let's start with Edmon first. I'd love for both of you to give us a little background about your the breadth of your career and how you got to this point. Edmon?
Yeah, definitely. So I have a pretty diverse background, not exactly the typical PE fund manager route. So moved to the States when I was fairly young. I was about 8 years old when we moved over from Denmark. My family was in the restaurant business, so I did that growing up. Then in my late teens, we sold, and I ended up running Aldi grocery stores for about 5 years. I was a store manager there. I was one of their youngest store managers. Made the shift into financial services, started out in the broker-dealer world. Then I went over to fee only, spent a couple of years there before Jeanine and I went out and started Opp Zone Capital. So not a linear path to the private equity world at all.
And my background, I'm a nursing home administrator by education and turned into entrepreneur, started a portable moving and storage company here in Clearwater, Florida that was labeled PODS, Portable On-Demand Storage. Our family started that here. We franchised that globally over a 9-year period of time. That was my bailiwick. I was the franchise sales director and global relations person. That made up about 70% of our company. Retired early, and that lasted about 6 months after a large weight gain, and got into non-medical or non-emergency medical transport. Grew that business, sold it off, and got into the real estate game. And when the non-compete was up with storage, wanted to re-enter the industry. And I contacted my good buddy Edmon to help me figure that out. And the idea was born to put it into an opportunity zone. And when I figured out the strategy behind that, given the exit that we had in 2007, I got a little angry that I didn't have financial advisors at that time to help me strategize on that tax saving. I said, can you build me a spreadsheet and show me what that looks like? And I got sick to my stomach. And I vowed I would never do anything else again without some kind of a strategic exit and planning for those taxes. So here we are today.
So you found your savior in Edmon to get your finances in check, and it's come full circle to now becoming business partners, huh?
It is, and quite frankly, it's a passion. I mean, it's anybody that we can save money and enhance their wealth. Oh, I'm all for it.
Yeah, absolutely. I mean, we have a mutual contact who runs several accounts for very high net worth families, and he is so surprised with how mismanaged a lot of these high net worth families are with regards to their finances. So to have somebody in your corner like our mutual friend, and also somebody like Edmon, it's invaluable. One thing I wanted to bring up with when we first had, we've known each other for a few months now. We met at a family office club event in New York City right before coronavirus kind of struck. And one thing you mentioned, Jeanine, was you guys have a no a-hole, I'll censor this, a no a-hole culture. You want to deal with good people. And I want to hear more about that and how your culture kind of materialized from that.
Sure. So, I'm a lot older than Edmon, so I've had a few more opportunities to deal with less than desirable personalities, and I'm just to a point in my life where I only want to have fun and a good time. I need to laugh a lot, and I laugh probably 80% of the day because I have such a great partner. But more importantly, I find that when you're having fun and you surround yourself with fun people, you tend to make a lot more money that way, and better relationships. And when you're dealing with wholehearted people, the world is just a better place. And we don't have any room for that in our business or our worlds, and we're so very well
definitely
like-minded, right?
I agree, and I would say our jobs are difficult enough as it is. You know how the financial services world is. You know how the real estate world is. The last thing we want to do is spend 12, 14 hours a day dealing with the undesirable people, as Jeanine calls it, and it's really helped groom our culture. Honestly, our advisory team, everyone from our executive assistants, it's like a big family, and it just makes operating that much easier. There's no drama.
There's plenty of nice people out there.
Yeah, exactly.
Yeah, there's plenty of nice people out there that you can do business with. You can avoid the negativity out there if you really want. I want to go back to your diverse backgrounds. I think this is very interesting. Both of you are not the typical high school, college, MBA, coming back to a big city and working for an investment bank. And then, maybe after 10 or 15 years of grinding through corporate America, you decide to go off onto your own and become an entrepreneur. You have backgrounds in restaurant and hospitality, grocery store chains, financial services, self-storage, medical transportation businesses. And now you get to a point where you have partnered up and you are now raising a very large fund through the Opportunity Zone tax code from 2017 to now go out and purchase, develop, operate, several asset classes of commercial real estate. How does that come about? Walk me through. How do you put such diverse backgrounds together to form a successful company?
Definitely. So I think one of the big things that bodes well for us is we don't operate in theory, right? And that's not to say that education isn't important. I actually start my MBA here in August, but I think all the experience that Jeanine and I gained over these past 20 years helped us identify the right people to put together on this team, how to truly execute in this space. And I think that's a world of difference. If you look at the composition of our team, our advisory team is a bunch of ex-PwC managers, all great people, brilliant, tax and accounting experience on hedge funds, mutual funds, real estate funds. And if you look at our vendors, we pick, best of class vendors. I think all of our previous experience helped us execute on that. So instead of going the traditional route, like you said, high school, grad, MBA, and then having to grind it out, we were able to walk in and say, okay, we know how to put together teams. We know how to motivate people. We know how to execute. And I think that's a huge advantage for us, honestly.
Yeah, infrastructure.
Let's dig into your Opportunity Zone fund a little bit. But before we get into the nuts and bolts of it, I do want to ask you your strategy or your business plan 6 months ago before coronavirus, and if it's changed at all with regards to your targeted acquisitions, your fund structure. Has anything changed from, say, 6 months ago to today with regards to kind of the nuts and bolts of the fund?
Yeah, absolutely. So for Fund 1, the fund that just went live for us, we had originally identified 5 assets at the time. 2 of those happened to be hotel assets that were going to be historic rehabilitations. And it would have taken about 12 months to do those rehabs, place them in service, still qualify for the Opportunity Zone benefit. And as you know, COVID hit, and we luckily had a chance to step back and say, okay, we don't know what this environment is going to look like 12 months from now or 18 months from now. Probably not a safe bet to move forward and take down these hospitality assets. We also had a assisted living facility in this first fund, and with that, we're definitely a little more comfortable there, but we did have to make a lot of design changes. So structurally, the fund didn't change too much. We still have a hotel asset, the assisted living facility, and a couple mixed-use multifamily assets out there. But and obviously we never wish a global pandemic ever, but it did allow us the time to really step back, refocus, and say, okay, which assets that we've identified need to come out of this portfolio, which ones are the best, can stay in, and then go identify the new ones. So we are actually now going to be at the assisted living facility, the 2 multifamily / mixed use, and 1 hotel asset. 3 of those projects are here in Florida, and 1 is in Mesa, Arizona. And that's with our co-development partner, 60 West and Palladium.
We still stick to our 3 major asset classes. We just rebalance the portfolio, if you will.
Mm-hmm.
And I'm glad you said that, Jeanine. So one of the benefits, I think, of us being structured as a multi-asset fund in the Qualified Opportunity Zone program instead of the single asset fund is we have flexibility, right? So if you were a sponsor with a single fund and you'd already closed on your asset, your principals got their capital in, and now COVID hits, and let's say you had a hotel going up, you're stuck, right? You're either not going to build that hotel, you're going to have to wait. With us, we're able to shift assets, not only prior, but also during the program. So where these single asset funds are going to have to hold their asset for the entire 10-year period, we have the ability to dispose of assets as long as we recycle that capital within 12 months. And I think that'll help us big time 5-7 years down the road, depending on where the market is, being able to dispose of an asset when times are good.
It only helps the investor.
That's the biggest difference. That's your point of difference in my eyes with regards to all of the qualified opportunity funds out there versus yours that is structured as a multi-asset fund. Was that your strategy going forward with regards to putting together a multi-asset fund so that you were able to kind of be a little bit more nimble with your investors and have them be able to be a little bit more flexible with the capital that was coming in and leaving the fund?
Definitely. So we've obviously gotten three rounds of regulations for us to get to the final regs. And as they were progressing, we kept looking at them going, okay, what is the best way to structure this? What's going to be most advantageous, and what are people going to balk at, right? So the first one is the 10-year hold period. So we looked in and said, okay, how can we make people comfortable with tying up their capital for 10 years? So that was where the multi-asset structure really came from. One thing we did was we did jump in early. So before the final regulations ever came out, the multi-asset limited partnership structure could not sell assets at the subsidiary level. So that would have been an issue. We would have had to sell our interest at the qualified opportunity fund level. So we kind of took a leap of faith as a team and said, okay, what are the chances that Treasury doesn't make this change and bring parity to the fund and the subsidiary level? And we jumped the gun and we did it. And then on December 20th, when Treasury blessed us with 544 pages of final regs, the first thing I did was jump in, find a ruling on that, and it ruled in our favor. But it was planned from day one. I look at it no different than when I spent my time building equity portfolios, right? We want diversification. So that's asset class diversification. We want geographic diversification. I want some ground up development. I want some rehabs where we meet the substantial improvement rules. So just anything to de-risk our portfolio is how. Another thing that we were getting pushback was, great, I get to defer my taxes out to 2026, and I get a 10% step up in basis in the meantime, but I'm still owed a 90% tax bill. So what we've done with all of our models is make sure that either at year 3 or right around 2026, so 2 different time periods depending on the size of the project, is we'll do debt finance distributions to make sure that we return capital to the investors before that tax bill is due. So a good example is the project in Mesa that I was mentioning before, our mixed-use project. In year 3, when we refi that project, it is 100% return of capital to the investors at the fund level. So, like I said, our big thing is be LP friendly, be flexible, and get them their money back as soon as possible.
We jumped right into the specificities of your fund, but I want you to go back, Edmon, and give the listeners just a very top level 30,000 foot view of what a qualified opportunity zone is.
Absolutely. So qualified opportunity zones are essentially underserved, distressed communities that have been designated by technically the governors of each of those states. There's 8,764 designated census tracts nationwide. And what the Economic Innovation Group and our government did was they said, okay, we'll designate these opportunity zones, these census tracts. And the way we think we can incentivize investors to go in there is by offering a couple of tax incentives. So these aren't tax credits, it's an incentive, right? So the first benefit is the deferral. So if an investor triggers a capital gain, they have to place that inside of a qualified opportunity fund and they can defer their liability out to 2026. The second incentive is they get a now 10% step up in basis because we passed 2019. Had an investor invested prior to 2020, they would have got a 15% step up in basis. So we've got a deferral benefit, we've got a step up in basis benefit, but the big one is at the 10-year hold period. When you hold your interest at the fund level for 10 years, when you dispose of that, you get a step up in basis to fair market value. So that is a complete exclusion of all gain in the fund. So an easy example would be, I put in $1 million. My interest is now worth $3 million. I dispose of my interest at year 10. My $2 million gain is never taxed.
So on the asset level, do you have what are your projected holds? I would assume are for the full 10-year term to reap the full capital gains benefits. Is that correct?
Correct. So everything is modeled out at 10 years, but the way we set up the structure was, even if we liquidate an asset or we dispose at year 5, we can take those proceeds and reinvest within 12 months and tack on the holding period. So we don't start over the investor's clock. Single asset funds can say that. If a single asset fund sold at year 9 and then reinvested, they just started their 10-year clock over. With us, as long as we're doing the reinvestment within 12 months, the holding period tacks on.
Jeanine, let's talk about your family started Pods, portable on-demand storage. You grew that company by leaps and bounds. You personally, as I think you were the head of global brand partnerships before you guys exited in 2006. Tell me a little bit about how your experience with the family business is translating into incorporating the self-storage component of the Qualified Opportunity Zone Fund.
Sure. Well, self-storage has proven itself time and time again to be very resistant to market fluctuation. When times are good, people buy things and they store them. When times are bad, people downsize and they store things. You have a baby boomer population. You have a lot of migration north to south, hence the diversity in our geographical selection. Self-storage time and time again. And we're very specific about self-storage. We're not going into a major metro area. We are going into secondary and tertiary markets where they are underbuilt. Again, meeting our plan of the 10-year hold, so we wouldn't hit oversaturated marketplaces. In addition to that, we're very strategic in the placement thereof for larger non-residential type utilization.
I think one of the more important things that Jeanine didn't touch on it, that she brings into the program, is her ability to build infrastructure, right? As you know, building a global brand is not simple. And what they did in short order with Pods is pretty miraculous.
Truly, it's not just that it was a great name and a great concept. It was the infrastructure that allowed us to grow, be able to franchise and duplicate at the speed at which we did. We nearly doubled annually, and then that prepped us for sale in 2007. That's the attraction. Let's
talk about your business relationship with 60 West. 60 West is your development partner. How did that partnership come about? And how have the synergies kind of strengthened over time since you launched your fund and you identified these projects you're currently working on?
Yeah, definitely. So we originally met 60 West about a year ago, and it was through a general contractor here locally in Tampa that I did consulting work for. They were actually looking at the Clearwater Senior Gardens Assisted Living Facility project together, and they put us together with Steve Holden and Steve Burks over at 60 West. We had a few conversations, and then unknowingly, as we were building our back office infrastructure, getting everything ready, they were out and about in the marketplace, closing about, I think at that time they placed capital in about 6 different opportunity zone deals. And as the relationship grew, we both noticed 2 things. They had a nearly endless pipeline, which you'll see as Fund 2 and 3 roll out. And we had the infrastructure, fund management, experience, the tax and audit, tax and accounting experience, the background to support that growth. So 2 of the 3 projects, actually 2 of the 4 projects, in Fund 1 are co-developed projects with 60 West. Fund 2 that'll be coming out in a couple months is a co-sponsored fund with 60 West, where we'll be doing everything together. But what makes the relationship so beneficial on both ends is we both complement each other really well. And 60 West has a background in development with either tax credits or tax incentives, and they've been doing that for about 30 years. So obviously the Opportunity Zone program for them was, honestly, they're probably the happiest people on earth when that regulation came through. So what we're able to do is fill the gaps in each other's teams. And we couldn't be happier having them as partners. Yeah, and it does. It makes us fully integrated. So whether an investor comes in and they have cap gains, or if they're an ultra high net worth individual who has passive income, we can utilize a specific tax strategy and help them out.
We're going to conclude this episode with the hard-hitting questions. These are the questions that we ask every guest. I'll bounce back and forth from you both. I want both of you to answer this. Edmon first. What is your why?
My babies, for sure, man. I've got a 4-year-old and a 7-year-old. My 7-year-old is autistic. My 4-year-old is just a jerk. I don't know what his excuse is, but they're my wife.
My
Jeanine?
wife, it's definitely my girls, and teaching them how to maneuver the world, build and preserve wealth.
And so, Jeanine, besides your little girls, and what gets you out of bed every morning? Also, besides your alarm clock, what gets you out of bed every morning?
That's so easy. Opp Zone Capital, and when I tell you that I have fun every day, I have never felt this alive as when I did at Pod. It is that much fun, and we're doing wonderful things for these communities, and that just makes my heart swell.
Edmon, what's a recent book that you've read that has provided significant value to your life or career?
The Code to an Extraordinary Mind. Just an amazing book, man. Vision's brilliant. Everything that he's done at Mind Valley is amazing. And it just helps me think, outside of the box. Really great book.
Who's the author of that? Do you know?
I'm going to butcher his last name. Lakiani. Hold on, by the way. I'll let you ask Jeanine the last one, and I'll get that book.
We're going to get a visual of the book.
I think you did that properly.
Yeah.
There you go.
Sorry, edition. If you download this podcast.
That'll all be edited out.
Perfect.
Jeanine, how do you pay it forward?
Oh, how do I pay it forward? Every way I can. I think my strong suit is meeting with younger people and trying to mentor them the best way possible, in whatever facet I can add value.
Edmon, what's the best piece of advice that you would give your 21-year-old postgraduate self?
Go back and study partnership tax and law, and you'll never not have anything to do in life.
I like that. Jeanine, how can people learn more about you as an individual or company, or get a hold of you?
Well, they can visit our website at OppZone-capital.com. We are doing a full reno on that website. They can call me at 727-647-9417, or they can email me at Jeanine@OppZoneCapital.com.
Edmon?
Yeah, same thing. So I'm super active on LinkedIn. So just Edmon Rakipi at LinkedIn. or they can jump on our website, like Jeanine said, OppZone-capital.com. And my email is really simple, Edmon, EDMON, at OppZone-capital.com.
Awesome. I really appreciate both your time. Jeanine, Blake, Edmon Rakipi, thank you so much for adding your value today.
Thank you, Nick.
Thanks for listening. If you enjoyed this episode, please make sure to leave a rating and a review, which will help us introduce the podcast to other listeners. Also, don't forget to subscribe to our YouTube channel, which will give you access to other episodes you may have missed. Lastly, if you'd like to learn more about investing alongside us, then head on over to valueaddedpodcast.com. Have a great day, and we'll talk to you next week.